The positive equity market returns, and in all asset classes we've had for the last 5-6 years, we think is coming to an end. So one should not expect a continuation of that trend, which has been approximately 18% a year in the equity markets for the last 3-4 years, and almost double digits in the bond market. We expect a higher level of volatility, as we discussed, and a lower level of base return, almost beta return, coming from most asset classes. So our suggestion would be that you have to focus more on other sources of return that are not just capital gains related, but are more, whether it's income, whether it's dividends, other processes or solutions that provide you an outcome.
Yeah, I think returns expectations need to be anchored on what long-term earnings growth has been for the market, which is around 8%. Now, if you think that's base case for earnings, and then you've got to assess, well, how much of that can I get from dividends? How much do I get from interest? But and also put in context that a year ago the market increased, well, international markets increased 46%. This year it's looking more like a flat outcome. So I think there are opportunities in the market. I think you need to be selective in where those opportunities are, but they need to be anchored around this 8% constant. And certainly with increased volatility coming back into the market from both an income generation perspective for the fund or even identifying new opportunities, it does pay to be more selective in these sort of market conditions.
The most recent reporting season was quite interesting in that both Europe and the US sales growth year on year was close to 0%, but earnings growth was 4 to 8%. So what you are seeing is a continuation of cost cutting, efficiency, margin enhancement, even share buybacks supporting the earnings picture, but revenue's not there. Now, we don't see that dramatically changing going forward. We see Europe continue to have its various issues that will prevent significant economic expansion and sales growth on that side, while the US we think will have some level of support, but we see the earnings expectations of approximately 7 to 10% as being quite challenged in that environment.
The healthcare exposure has changed over the last 18 months. 18 months ago, we owned more of the pharmaceutical names, the drug manufacturers, and we started to see increasingly opportunities in the healthcare services space. Primarily that was driven by valuations, concern about the introduction of Obamacare or the Affordable Care Act, depending on which political wing you're in, started impacting share prices. And particularly the large health insurers, United Health, WellPoint, we had exposure to Express Scripts at that point as well, and we were increasing those exposures. And a core thesis of why we're attracted to that industry was really a sustainability issue, where healthcare costs, they're around 18% of GDP in the US versus in Australia they're closer to 10% of GDP. They're almost double the cost. And these costs have been increasing steadily year on year on year, and it's unsustainable that trend can keep continuing. Now, the healthcare services businesses increase their profitability in many cases by lowering healthcare costs in the US, whether it's a transition to generics with Express Scripts where they have a higher gross margin, whether it's in the health insurers industry through their greater scale they can lower healthcare costs and still retain more profit themselves. So there's a number of levers they can pull that lower overall healthcare costs, but increase the profitability of the business itself. So we stepped into a lot of those names about 18 months, 2 years ago. There have been significant performers since then. And the real driver for that, I think, has been a perception in the US that the Affordable Care Act is actually not going to be a net negative to these businesses, but is going to be a net positive. So our healthcare exposure then, as those stocks have recovered and our valuations have been met, we have started trimming a number of those positions. They certainly contributed to the portfolio in a very positive way. We're retaining our position in Express Scripts, which we think has a longer tailwind, but that's how the portfolio, I think, has changed over the last 18 months.
Yeah, so obviously, as you know, the oil price dropped approximately $25 or 30% in the last couple of weeks. And the implications, or why that happened, was supply came in a little bit greater than expectations and demand came a little bit below. But you're talking probably 1 or 2% on the global picture. And it's that level of small movements that actually create very large movements in price. We think two things are going to happen. There's going to be a slight demand response, as you would expect, But the other key difference that's happening in this market that's quite unique is most commodity markets have a supply response both on the up and the down that significantly lags the demand response because of the time it takes to switch on or off production. But the most recent occurrence within the energy space is this shale oil of very short dated production cycles. So the movement of supply catches up a lot quicker, and we expect a supply response to normalize that market and bring it back up to a marginal cost of around $90. So we expect oil prices to recover during the course of 2015. And when we looked at certain companies that have very low cost of production, very good quality, low decline assets that would significantly benefit from, well, one, that would be viable at the current price, but significantly benefit from that environment that wasn't being priced into the market, we took advantage of those. The majority of the oil market spends whatever it earns. It takes its cash flow and it spends it, and to a large extent that's what the market wants often at a point in time. But from our point of view, we're looking for businesses that generate free cash flow, that distribute that in dividends, share buybacks, that actually grow intrinsic value over time. And those are few and far between within that sector, but companies like Occidental Petroleum, Denbury Resources, Canadian Natural Resources are very much cash flow focused, return on capital focused, have low decline assets, and that's where we've chosen to invest in.
Well, I think the geopolitical risk in the energy markets, which is the change in Saudi Arabia's role in the oil market, whereas historically they would act as the marginal supplier of liquidity to either protect the oil price or to tame it. They could turn off or on production quite quickly. And I think the change in that dynamic, in that relationship, is that over the last 2 or 3 years, the US has emerged as increasingly the balance of power in terms of that liquidity, or a competing power for that marginal supply, which has de-emphasised Saudi's role in global oil markets. Now, Saudi Arabia needs a high oil price. They have significant social costs in their own domestic market. Estimates are around $90 to $100 oil prices is what they need internally to be able to fund those obligations on a go-forward basis. So it's not in their interest to sustain an oil price around $80, which is where it currently is today. So one theory why they're allowing it to persevere is to try and rein back some of this tight oil production in the US, try to turn it around to some extent so they can reassert that power. Now, in any case, whether the theory is right or wrong, because of these high social costs that they have in their domestic country, because of the necessity for them to have a $100 oil price going forward, we think it's a short-term issue and will come to pass. But it's a new dynamic which I think is affecting oil price volatility, but doesn't or should not affect the long-term fundamentals of the oil price, of where the oil price should settle in the longer term.
The geopolitical risks are actually an upside risk to us. So from our point of view, if those risks eventuate, the oil price goes up, and that would be positive to our view of our investments. QE, we think, has provided some level of calming of volatility, and you can see that from the onset of QE, approximately 2009, the VIX has traded at a very low level, at the low teens and even under that for some period of time. So we see the end of QE as taking away some of that support, and that should lead to a high level of volatility, because higher interest rates, frankly, do lead to greater volatility. There's a very strong correlation with that. And as the market prices in that QE is not there, but maybe interest rates might be rising, you're going to see more of that. And we saw a bit of that in October. So because we see volatility increasing, we expect equity markets obviously to price that in more accordingly and be more volatile. And our process is actually a significant beneficiary of volatility. We take advantage of volatility from new opportunities on the stock side, as well as our investment process actually getting paid for taking positions. We've been quite hesitant to invest in Japan for quite some time, and that's for a range of reasons that have not changed. And those reasons are generally relatively weak corporate governance vis-a-vis US and Western Europe, a very bad domestic demographic backdrop with a declining population and an aging population. And Japan has struggled for, frankly, the last 20 years to emerge from a no inflation, almost no growth scenario. And Abenomics, in our view, has been a failure. The fact that the polls indicate that, the fact that they've had to delay the VAT, the sales tax increase, the fact that they've done a surprise massive injection of QE in the last couple of weeks, is all indications to us of a panicked situation from a government point of view. Now, putting those things together with a weakening yen on top of it, which we think is going to continue, we see relative to the opportunity set elsewhere, we don't see Japan as an attractive source of opportunities.
Okay, so the flash crash, and I'm referring specifically to October 15th, which it's a well-known event in credit markets and fixed income investors, but I think it's less well-known amongst equity investors and the broader market. And what happened on that day was 10-year spreads, US government spreads, moved 33 basis points intraday, which is not a lot from a volatility perspective, is not a lot from an equity investor's concept, but certainly from a fixed income investor's it is. I mean, that represented a volatility of more than 7 standard deviations intraday. Now, what's driving that? What's driving that increased volatility in fixed income markets? And the reason we believe it's being driven is that decreased liquidity in that market. You've seen increasing notional exposures in fixed income, but because of one of the natural providers of capital in that market, which has been investment banks, which has been prop desks, which has been the sell side in general, because of capital restraints on their banks' balance sheets, those businesses have shrunk. Dealer inventories are coming down despite this growth in notional exposure, which has directly led to decreased liquidity in that market, and decreased liquidity should lead to higher volatility. That's what you're seeing. Now that caused a significant ripple in fixed income markets. Now, when we look at that from an equity perspective, equity investors' perspective, and we look at our financial exposure, we look at our investments in Citibank, in Barclays, in businesses that are exposed to this, they're exposed to it through their regulatory capital and this trend that has been shrinking their prop desk and shrinking the amount of capital in these businesses, which has led to that decreased liquidity. And I think that it's a recognition that if that's the impact, it's an unintended consequence of these ever-increasing regulations. These regulations can't keep increasing forever. And it's a signal, I think, that we're nearing the end of that phase. We're nearing the end of these increasing tightenings of regulatory capital. Now, evidence of that came through about 2 weeks ago in the UK when they announced leverage ratios, which were far less onerous than what the market was expecting. And as a result, Barclays, one of our investments, increased 8% on the day. That's an indication of how material this issue is to a bank's capital structure. Because if a bank is hoarding less capital, it's keeping less capital on its balance sheet, it means there will be more capital for equity investors, either through capital return, through dividends or buybacks, or more capital available to reinvest in the business, in more loan growth, in credit growth, both of which are very beneficial from an equity perspective.